So let's look at how candles are formed and what they actually imply in the market. So the first thing you want to pay attention to is the open of the candle. All right, so a candle opens at a particular time of the day, depending on the time frame. So we have different time frames. We have the 1 hour time frame, we have the 4 hour time frame, we have the daily time frame. All right, so all of those are time frame that the market, a candle forms. All right, so we can see, you take a look at this here, you see this is the 4 hour time frame, this is the daily time frame. So all of these have specific candles based on their time frame. So in this case, we are just making use of a generic information here. So let's say a candle, which is the 1 hour candle, opens at a particular point. So we see the candle opens by 5 o'clock, another candle opens by, okay, let's take a look at this. Let's imagine that this is the 1 hour time frame, right? So what that means is that this opened by 5 o'clock and closed. This opened by 6 o'clock and closed. Let's make it a little bit bolder. Okay, this opened by 5 o'clock, closed. This opened by 6 o'clock and closed. This opened by 7 o'clock, closed by 8 o'clock, by 9 o'clock, 10 o'clock, and so on and so forth. All right, if these were the 4 hour candles, this would be by 6 o'clock, the next candle will be by 10 o'clock, the next candle will be by 10 o'clock to 2 o'clock, then 6 o'clock, and so on and so forth. If this were the daily candle, this would be the first day, Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday. Sorry, Saturday is not included. The markets are open from Mondays up until Friday. All right, so we have free days on Saturday and Sunday, except for the cryptocurrency market, of course, which is open 24/7. But the Forex market is open 24/5 from Mondays up until Friday. So let's go back to what we're discussing. So let's say the market opens at this point. Let me make this a little bolder. Yeah. So this is the open price. The market opens at this point. Now, once the market opens, there are two things that can happen. The market either goes up, right, or comes down. It either goes up or comes down. So that is the first thing that happens. Now, when the market goes up, it can form a high or a low. Now look at this. So we see the market going up. The market opened at this point and started going up. And then at some point within that 1 hour, it started coming down. All right. And sometime before the hour of that candle, a time, let's say sometime around 1:40, the market started pushing up, and around 2 o'clock, the market stopped. All right. Now, this point is very important. The market opened at that point. The candle opened at this point, pushed high to this point, and within that same time period, within the 1 hour period, remember, the candle you are looking at is dependent on the time frame you are actually currently on. All right, so the different time frames determine how the candles get to move. All right, see, look at this. This is the 4 hour time frame. This is the 4 hour time frame. Now, this 4 hour time frame, within this 4 hour time frame are 4 other candles within it that make up this 4 hour time frame. Okay, if I move to the daily time frame, which is the 1 day time frame, within this 1 day, within this candle right there, are 4 candles, 4 hours of okay, how many hours make a day? 24 hours. That's 6 candles. Within this point, within this single candle, you have 6 4 hour candles. All right, so those are how the candles form. Now let's go to the 1 minute time frame. I love the 1 minute time frame, when explaining this, because it makes a lot of sense. Now the time currently is 7:31. This is the candle currently moving. This is 7:31. Once it's 7:32, you'll notice that a new candle will appear. Yes, a new candle will appear once it's 7 7:32. So currently we have the time at 7:31. So we have less than 1 minute to form a new candle. All right. So let's look at this. Now this is 7:32. A new candle has formed. An entirely new candle. So we just opened this candle. Whether it's going up or coming down, we don't know yet. We see that it has gone up at this point. Immediately it opened, it pushed higher. Now it has pushed down. Okay, so one thing I want you to do is to go to your charts and then try to monitor and try to understand the 1 minute candle. Try to see what is going on within that space and try to see how it forms. What makes it change color from one color to another? Okay, taking a close look at it will help you understand how the candlestick form even on the higher time frame. Okay, so let's get back to what we're doing. So, where is my line? Okay, let's make use of a different line. Can't find my line. All right, so we have a line right there. And so the market decided to push high. It opened at this point and then it started moving up. Okay, within that 1 hour, it also started moving down. Within that 1 hour, it moved up and then closed there. So this was 1 o'clock candle and then it closed at this point. So when it closed at this point, it formed a new candle. It formed a new candle. So a new candle will open, a new candle entirely would open at the close of this candle. All right. So I'm going to explain that, but let's try to depict this in um, pictorial form. All right. So we have the open of the candle, it pushed higher, came down to this point and closed at this point. So this is our open price right there. I think I should make use of a text right there. This is our open. And then this is our close. I'm trying as much as possible not to make this video so long, right? Because this is just one of the little basics that I think is not well spoken about, and people just have to know it, especially traders who are new to the system. They really need to understand this. Okay, so we have also the high. We have the high, and then we also have the low right there. Now, yes, so what you want to do is you want to see how did this trade actually form. So what I do actually is I begin to do this. This is how I actually teach my students. Okay, so I bring out the high, I also bring out the low, and then this is the open and this is the close. Now, the open and the close is where the wick, from the high to the open, is where the wick likely would form. The low to the close is where the wick likely would form, right there. All right, so let me make this a full screen. So, okay, so we see this point here would be the candle there. So this is what the candle looks like. And the candle in this case, because it pushed up, came down and closed below, is going to be a red candle. So this would be a red candle. So let's see how we can fill that up. So we have a red candle right there. So this is going to be a red candle, even though it's not very It's not very deep in color. Let me make it a little, okay. I think that's not, okay, here, a red candle. All right. So this is exactly how the candle would look like if this kind of movement occur. So let's take another example entirely. So let's say since the candle closed at this point, this was the close. Once this candle closes right there, a new candle opens by its side. So let's say this is the new candle that opens. So we have the open right there. So this is the previous candle. This becomes the open of this place. Okay, now let's say the market price decided to do this. Immediately it closed at this point, it opened a new candle and then this pushed lower. Okay, it pushed lower, pushed higher, and then closed here. Now, in this case, this is similar to what has happened here, only that the distance of price was a little different. So what am I going to do? This is the open. This becomes the low. So sorry. This becomes the low. Oh, this becomes the close. And also, sorry, this becomes the close right there. The close where it closed. And this becomes the high. This becomes the high. Just like we did before, we mark out those areas, the high, we mark out the low, we also mark out the close right there, and of course we have the open. So what do we do now? Let's see how the candle must have formed. Now the first thing that happened was that the candle moved down. So since it moved down, we had the market pushed lower to the downside. All right. Now, what I want you to understand is that this candle that shows this wick, this is a wick, it's called a shadow or a wick. It was once a full-bodied candle. All right. It was once a full-bodied candle towards the downside. And of course, when the market moves down, we're expecting red in color. Okay. Is red once it moves down. If it starts moving up to this point, then it becomes green. All right. Now the green or the red is dependent on how you set your candlesticks, because people modify their candlesticks. Some people make use of black, some people make use of white, regardless of what colors. But the color that comes with the platform, most of the platform is red and green. Okay, so we have this, which was once a red candle below. So once it pushed down, it started pushing up, and then it began to form this right there. So this is what it started to look like. So at some point, it pushed high to this point, and then still came down and closed right there. So since it reached to that point at some point, we know that it would also form a wick. So you would notice that it also formed a wick from the high right there. Where is my candle? All right, so it forms a wick from that point straight down here. So this is what the candle would look like after this closed below, this opened right there, formed a push to the downside, moved high to this high, and then pushed lower at this point. All right, so that we don't waste time, I hope you have been able to understand this. So this is a bearish candle. This is a bearish candle in red because it pushed up, came down, and closed right there. Okay, in this case, we pushed down and pushed up and closed here. So we closed higher than the open price. In this case, we closed lower than the open price. I want you to take note of that. Closing higher than the open price makes it a bullish candle. Closing lower than the open price makes it a bearish candle. So let's go straight and let's look at how the market, looks like. All right, so what we are going to be looking at now is how we can actually take trades, understanding how these candlesticks form. Now, one thing I also need to make known to you is that this push up and the push down has a lot of significance as well. Has a lot of significance. Now, the fact that it pushed down and pushed up means that the sellers, people who are selling into this pair or currency or cryptocurrency, had so much strength and pushed the market down. But along the line, within that same time frame, there was also a surge to the upside. All right. So what that means is that there is a lot of bullish pressure coming into that market. So you want to look for bullish opportunities. You want to look for buying opportunities because you see that there's a lot of bullish pressure going into that, pair in that time. All right. So you want to take note of a lot of things. Your context also matters when determining where the market would go. So this is just one of the many things that you want to consider when taking a trade. So the push to this upside, we had the bulls push the market up until this point. But at some point, the bears decided to take a little charge, but they were not able to close below that point. All right. If for any reason that they were able to close below this point, it would have been a bearish candle. And this is what it will look like. All right. I don't want to make this messy, but this is what it will look like so that you will get to understand a lot better. It will look like this. It pushed lower to this point. Okay. We opened at this point, we pushed higher and then we pushed lower. So it's going to look like this. Okay. And then we will have this, which is going to be green. Sorry, it's going to be red because it pushed lower than the price. So we also had price move to that point at some point. So this will be changing to red color. So this is exactly what it will look like if the market came down to that point. So let's look at live examples on the chart. So here's a very interesting example right there. Here's a very interesting example. Let me take a zoom into that trade. So in this case, we see, let me zoom in. Let me zoom in. So let me zoom into that trade. So you can see in this case, we see we are looking at these two candles here. We are looking at this candle and we are looking at this candle right there. Okay, so this candle, this candle. So with what I have taught you, you should understand that at this point, the market got open. We pushed high to that point and pushed lower below the open price. And then we pushed a little bit lower and then closed at this point. This is the reason why we have a bearish candle right there. Okay, so if you look at it closely, let me bring it straight to your screen. We pushed higher, came down, formed a bearish candle, came down to this point, and then pushed a little higher. So this becomes our high, this becomes our low, this becomes our open price, and this becomes the closing price. Now, would you take a sell on this trade? Absolutely not. And the reason why you should not take a sell at that point is because of what I'm going to be making known to you. But before then, let's look at this next candle. So we see the next candle. We closed here for this bearish candle. We opened at this point. Then we pushed down to this point. So the market actually pushed lower after it closed here. It actually pushed lower and then started pushing higher. It pushed so high to the point that it actually went to the point where it opened the previous candle and started going even higher. went high to this point, and the bears, that's the sellers, tried to push it down, but they were not so strong enough to push it below the price which it opened. So it ended a bullish candle. All right, so this is the kind of candlestick patterns that you might likely see on your textbooks online, and they tell you once you see this kind of pattern, you just buy without you actually understanding what the reason is behind this push. So the reason why you would take this trade is because you see that there is a lot of bullish pressure coming into the market, and you want to look for opportunities to actually buy. So how do you buy? Because you don't just want to buy unnecessarily. You want to know why you are taking a buy at that area. Like I said before, this is just one of the reasons for you to take a trade. So you want to look for many other reasons that can give you a confidence into taking that trade. So if I were to be the one seeing that this candlestick had made this kind of movement, it signifies that all right, we are in a good way. We are, we have actually seen a very good candlestick formation, and the psychology behind the formation is fair enough for me to get into that trade. So I'll look forward to taking a buy. And now I see this. Now this looks strange on my screen. Okay, I make use of a gray color. I'm not saying you should do the same. It does not make you profitable. All right, just trying to make you understand what the things I know, the little things I know, of course, yeah. Okay, so I make my transparency a little bit. All right, so that's fine. So we see that this area was a support. All right, so if you have not seen my previous videos on when I discuss support and resistance, you may want to go and check that out. All right, on how you can actually trade support, resistance, and actually setting your stop losses in a way that makes sense. All right, so we see this trade at this point. We see that the candlestick has formed there at this point, and we want to take a buy because we are not just looking at the candlestick that formed. We also see that there is a support area, which also solidifies the fact that this trade makes sense to go in. So we decide to take a buy right there, and can decide to put our stop loss below, right there, below the support area. Okay, or we can decide to take it a little further and then target high. Okay, maybe having a risk reward ratio of 1 to 2, which is fair enough. And you can see how well the market got straight to our target. Okay, so it's easy to actually see these patterns on the charts when the markets are not moving. But once the market begins to move, there's a lot of emotions that now begin to come in. All right, we see the market push down, goes up, and a lot of things begin to go into your mind as the candlestick moves. All right, so it is just one thing to understand the anatomy of candlesticks, to understand support, resistance, to understand quite a number of things, risk to reward ratio. There are many things that you can get your hand around, but at the end of the day, it all depends on your ability to master yourself, which is one thing I'm going to be discussing in consequent videos. All right, so if you enjoyed this amazing video, do well to share and also subscribe to this YouTube channel. That's the only way you can actually support me.